That's what Martin is saying in the live chat. Good evening to everyone. Happy hump day indeed. It is a Wednesday night. It is 6 p.m. Australian Eastern time. So that means that it's Selfwealth Live time. We should probably just replace that part on the clock and in the calendar and just have Selfwealth Live. I know for some of us it's like religion. We've been doing it for 12 or 18 months. So happy midwinter to you too, Alex. Tonight is a very special night. We're going to be talking about writing. We're going to be talking about investing, and we're going to mention a few global companies in here as well. And we have an extra special guest with us tonight. This is part 3 of 4 of our Value Investor series, which is on behalf of Selfwealth and Intelligent Investor. And it's going to be a great session with John Addis, the founder of Intelligent Investor and editor. We'll get to him in just a moment. But as always, you can say g'day in the chat. And we start with this week's joke. So the joke this week is, are people born with a photographic memory, or does it take time to develop? Now, I think only people over 30-ish will get this one. Yes, there was a time, not that long time ago, actually, when you used to wait for photos to be developed. And you wouldn't just click a button and it appears and you can send it to your friend. So that is my joke for this week. It's quite horrible, if I'm honest. Maybe financial freedom gives me a 7 out of 10. Actually, I will take that. I will very much take that. So this week's disclaimer, the part that Rob, who is usually here but is not here tonight, he is away. I believe he's actually in an arts and crafts location in Indonesia somewhere, discovering how to make better disclaimer slides. But while he's away, I've stepped in and this is what I've got. The Selfwealth Live information warning goes as follows. Selfwealth Live videos contain general financial advice only. That means the information has not taken into account your needs, goals, or objectives. So you should not act on the information until you have spoken to a licensed and trusted financial planner. I put the trusted in there. The regulator says I don't have to do that, but I put it in there just because you probably want to trust the person who's giving you financial advice. My name is Owen, and I'm the sole director of the Rask Group Proprietary Limited, which is the corporate authorised representative number 1280930 of Waddle Partners, AFSL 383169. Every financial services business in this country should have a financial services guide available on their website if they give this type of advice. So that's a FSG. It's available on our website at /FSG. The views expressed in the live streams are solely those of myself and or our guests, for example, John Addis tonight, and do not necessarily reflect the views or opinions of Selfwealth. So Paul has given me a 10 out of 10 for the arts and crafts joke. So horrible, it's a 10 out of 10, says Jason. Well, thank you, everyone. I do very much appreciate those kind words. The disclaimer is what I get up for every morning. I've got to admit, it's at 6 o'clock every night, so I've got a long wait, but it's the number one thing in my diary. So the Value Investor series, part Intelligent Investor, part Selfwealth. It's happening. We are at part 3 of 4, and tonight we have John Addis with us to talk about the stories we tell. We're going to talk about a couple of companies as well. And next week, we will be joined in the final week by Nick Cummings from Intelligent Investor too. So it's been a great lineup so far. If you haven't already gone back and watched Gaurav Sodhi on episode 1 or 2, I would highly encourage you to do that because it has been fantastic. So without further ado, I'd like to welcome John Addis to Selfwealth Live, his first ever appearance. And I will just get rid of the slides here. John, welcome to Selfwealth Live.
Thanks, Owen. You'll see that I look nothing like that picture you just showed. I don't know when that was taken, but my hair is significantly shorter and less of it now.
Well, it was a very good hairdo. I might say that, mate. It's it does look very flattering, and
Yeah.
you look more comfortable now. I might say.
I feel more comfortable. That might be to do with the Steve Jobs turtleneck that I'm wearing in honor of our discussion tonight.
Oh, is that why? Okay, that makes a lot of sense.
Yeah.
I thought you may be wearing a turtleneck just around the home on a Wednesday, but
Never.
Okay, well, we will be talking a little bit about Apple and about technology, about writing, so many things. But maybe to get the ball rolling for people who aren't a member or haven't heard of Intelligent Investor, I would love for you to explain why you started the business many years ago and take us through that journey and how you've been involved with the business over time.
I probably started Intelligent Investor because I didn't really know what would be involved. Had I known, I'm not sure I would. And I think a lot of small business people feel that way. If you knew what you were up for, you probably wouldn't do it. But the motivation for it was a friend of mine used to be an analyst at Huntley's Your Money Weekly, which was purchased by Morningstar probably 15 years ago now. And he would bring home his analyst reports. And I was kind of into business. I'd already tried to start 2 or 3 businesses before Intelligent Investor. I was definitely into words. I was a freelance copywriter at ad agencies. And I would read these things in the bath, and I just could not make head nor tail of them. I was totally perplexed by the jargon, the acronyms, the cliches. There was just nothing there that said anything about the humanity of the person who was writing it or the life that is in a business. And when I spoke to him about this, he said, well, why don't we do something? Why don't we try and do it differently? So we spent about a year planning it, and we got it going, and we ran out of money after about 6 weeks. We put more money in from off our mortgages. And at that point, I kind of found he was meant to do the editing, and I was meant to be the marketing sort of business manager person. And it turned out that I'd started a business with somebody who publishing business with somebody who had dyslexia, which is a bit of an issue, but we got past it. But through that, I ended up getting involved in the research side of the business. And when Greg Hoffman joined, which is a former research director of Intelligent Investor, very, very smart person, he took me through, he inculcated me into the value investing approach. And he once said I was the only person who got it immediately. And I think I was just kind of primed for it. I'd invested in the past. I tried charting and technical analysis, momentum investing, whatever you want to call it, but none of it really felt right. And as soon as I started reading the value investing texts, the penny kind of dropped for me. And we grew pretty quickly. But in 2004, I had 2 or 3 things that were going on in my life that were kind of overwhelming. When you're running a small business, it's very, very intense, especially when you're making recommendations for people that will probably lose them money at some point. It's the nature of it. And I had 1 young child, another one was born, my father died, and I got diagnosed with leukemia in the space of about 3 months. So I decided maybe running the Intelligent Investor wasn't the best thing for me. I sold to two staff members, Greg and Steve, who were both ex-Macquarie Bank. I was still good friends with now. And I moved up to the North Coast. And then I did nothing for 4 or 5 years, really. Just spent some time with my kids. And then the GFC hit, and things had gone wrong at Intelligent Investor. And they called me up and said, do you want to come back? And I've been there ever since.
Thank you for that candid recount. It's very unusual to see someone in a small business come back in the way that you have, but then stay for such a long time.
I know, it's weird, isn't it? It is weird. I suppose what I like about it is, first of all, the community. Like, we've had subscribers who have been with us for 15, 20 years, and they know us and we know them. And that sense of belonging that I think we've created is an important thing. The people that I work with, I've known for 10, 15 years. There's one staff member that I recruited when she was 19, is now 40. There's a kind of, what would I call it? There's just a nice family sort of atmosphere to it. And I love the writing, and I love business, and I love investing. And this place combines all of those things. It was never really about the money. It was about what you do with your life, I think.
So Gaurav said something similar to me this morning. And for those who haven't seen the previous sessions, again, I highly encourage you to go and do that. But I was fortunate enough to catch up with him for a third Wednesday in a row this morning.
Really?
Yeah, it was
People will be talking, Owen.
Yeah, three times in 1 month. I haven't seen him for years, but then 3 times in 1 month.
Yeah.
But I mean, You said something there where you said that when you started reading financial papers, it was all so complicated.
Right.
And why do you think the learning curve is so steep?
Well, it's steep because it's hard.
Okay.
It's not easy, so it should be steep. If you want to beat the market, then you have to be doing something that's different to the people that are investing in the market, and that's hard. We're herd animals, so our instinct is to go with what everybody else is doing. That's hard. But I think the industry itself wants to make it hard.
Mm.
And when we started Intelligent Investor, there were funds that were charging fees of 4% in the way in, 4% a year, and 4% on the way out.
Wow.
And it's hard to do that. It's really, really hard to do that unless you're operating in an industry that looks really complicated, really difficult, and makes you feel stupid when you engage with it.
Mm.
And I think there's still remnants of that. It's got better, but there's still remnants of that. And I've got a friend of mine I go for a ride with every now and again, and he's a very smart person. And he said, "Oh, reading this research from," I won't name the broker because they're all the same, but he said research from blah blah, and he said, "I just can't work out whether I'm the stupid one or they're the stupid one." And I'm not saying that's deliberate, but it kind of is. You know, I think this is an industry where most of the companies in it don't need to exist, probably shouldn't exist. And to justify the fees that they charge, they need to make their clients feel as though they need to pay them. And one of the ways they do that is to make them feel small, make them feel stupid, make them feel they don't understand. And there was a Welsh playwright called George Bernard Shaw who wrote this a play called The Doctor's Dilemma, where there was one of my favorite quotes, which is, "Every profession is a conspiracy against the laity." And I think finance is like that. You know, the language that we use is exclusive, and we all feel as though we belong to the club. But in belonging to the club, we keep a lot of people out, and their entry into the club is the fees that they pay us. So that probably sounds quite cynical, but I think there's some truth to it.
It's interesting what you say about brokers. I've never been in that world exactly, but I was given an insight not too long ago from a former broker who said that the idea is when a client comes in is to confuse them, because then it lowers your risk of giving advice.
Right. That's right. That's right.
Because it makes them feel like it was their decision.
That's right. That's right.
Yeah.
Yeah. And I think a lot of the language that is used in finance has that effect on people. It's designed to confuse. And really, finance, when we talk about finance, we're made to think that it's about the numbers. And that's obviously, some of that is true. You wouldn't buy a stock unless you'd analyze the numbers in detail. But, and this probably gets us into the area of the companies that we'll be talking about, but there is a narrative attached to a company that can either resonate or repel us from. And often it's that determines the success of a business, less than the numbers themselves. The numbers themselves are a product of what's going on inside the business. And what's going on inside the business is very, very human. It's not financial. It's largely not numeric.
So one thing that I'm going to lift the curtain or look behind the curtain with listeners tonight and viewers and say that a lot of the people that I know from finance and investing are no better or potentially even worse with money than people who aren't in finance and investing.
Yeah.
And I'm curious why you think that is, when presumably they've been trained in finance.
It's a really, really good question. I mean, you're probably speaking to my biases here, but I would say that finance pays well. So it attracts people that want to be paid well. The connection between the job that you do and the fees that you get paid, or the salaries that you earn, isn't quite as strong as it is in other areas of life. You can underperform for a long time, and just status quo buyers will keep investors in the fund. So even though they have to perform on a quarterly basis, or theoretically, they talk about that, I'm not sure whether that's true. There's a lot of fund managers out there who have been doing a very bad job for a very long time and are still doing a very bad job. And if you look at the figures, most funds aren't around, like most funds that underperform are around for about 8, 9, 10 years. That's a long time to get found out.
Yeah.
It's a long, long time. So, and I think in superannuation, it's even worse. So I think the message for retail investors who don't want to manage their own money, and I think most people shouldn't be managing their own money, is to not concentrate on performance. It's to settle for average performance and get the lowest possible fee. That would be my advice to investors who don't want to manage their own money. Forget about performance, be happy with the average, and get the average at the lowest possible price.
Yeah, and I mean, another piece of jargon from the industry is you can get beta for free, right? You can get the market for free, basically. Like the fees are negligible these days. And if that is your perspective, then definitely that's the way to go, because it requires curiosity. It requires time to do what you do and to do what the Intelligent Investor team does, hence why the business exists, right?
Yeah.
I often talk, and I wrote just a brief email before for the Rask subscribers about this, how I don't think it's a coincidence that many of the better investors that I come across are also great writers, and they also seem to be great writers, not always, of course, but they often tend to be good investors. And I'm curious to know why you think that is. Like, what happens in the brain to make that happen?
Magic. I think it's magic.
Yeah.
If you look at I think you're right. There is a connection between the best investors and their ability to write. And I think that's down to the fact that writing is a clarifying process. And there was a quote by Joan Didion: "I write entirely to find out what I think." And I find that's true. You know, when I'm writing a piece, it forms as those words are hitting the page. So you stew on it for a week or months or days, and it forms through the process of writing. And I found that the good analysts struggle to get their thoughts onto a piece of paper. And often with a stock, there might only be 2 or 3 things that you really need to know, but you ask them to write 500 words on it, and they'll often write about the wrong things. And if you can't get that, if you can't communicate an argument to buy a stock in 500 words on paper, why would I trust you with my money? I just wouldn't. If people can't communicate that, their thoughts, and weight those thoughts accordingly, they don't deserve anybody's cash. So I think the writing has a clarifying aspect to it, and it reveals a lot about what the analyst is really thinking and how they weight the various aspects of a stock and a business.
I hadn't thought about the weighting component of it. I do think a lot about the clarifying thoughts and how people who write like an investing journal or something like this even can go back and reflect on that when the thesis or the reason for owning the company is broken.
Right. That's right. So you will have a narrative that comes from a stock, like the management of a company. There'll be another narrative from the brokers or the investment bankers. There'll be another narrative in the media. And then from the analytical point of view, we have our own narratives. So we would like to, when we recommend a stock, we have an idea of what this will be doing over the next 5 years. And there's a kind of anchoring effect to that. So when the company starts to go off track, you're not waylaid by the other narratives. You've established on paper what you think a stock will do over the next 4 or 5 years. And when it starts to depart from that, that should cause you to reevaluate it. But the narrative bias is very strong in all of us. And I think there's some people out there who are keen for us to get onto Apple and Microsoft and Google, but this might be a good jumping in point to those kinds of companies, because you can see that narrative bias in those stocks quite strongly, especially Apple, I think.
I think that's something. So Gaurav talked to me about this morning. He said that the job of an analyst in the Intelligent Investor team is basically to compare stories. So to compare the story of what the company tells us to what the economic reality is. And I know we're going to get to some companies now, but like we've seen this play out with many companies, whether it's tech companies or whether it's industrial companies. And maybe we can talk to that, now about the three companies that I know we kind of exchanged briefly over were Apple, Microsoft, and Amazon.
Mm.
And I know you think a lot about technology, just generally speaking.
Mm.
But there have been times in my career, which is admittedly quite a bit shorter than yours, where I've seen these companies and I've thought to myself, why doesn't everyone else see that these are fantastic businesses? And
Right.
I'm reminded of that phrase that markets climb the wall of worry, and there always seems to be something to worry about.
Yeah, there is.
But can you how do you think about the narrative that has surrounded these companies through time?
I think it's different for each one. Maybe we should talk about Apple first, because I think if you were to look at, say, Wall Street and say, well, how long did they get Wall Street? How long did Wall Street get Google, Amazon, and Apple wrong? And I'd say they probably got Apple wrong for the longest. And you look at that and go, well, why was that? And I think that the analytical mindset neglects kind of the liberal arts. And I think investing is a liberal arts activity as much as it is a financial activity. And if you knew anything about Steve Jobs, and I knew quite a lot about him because I'm kind of an Apple fan. And when we started Intelligent Investing, they came out with the first iMac. I bought 15 of them and put them all around the office. And they were just different. Like, computers were really boring boxes. They were ugly. They were kind of hot and noisy. They didn't consider the user. And Steve Jobs always said about Apple was that Apple operated at the intersection of technology and the liberal arts. Now, if you speak to most analysts, they probably won't know what the liberal arts is. And they won't understand what that really means, is that it's not just about technology. It's about how the user interacts with that technology. So when Apple progressed to, say, the iPod, which was the kind of breakthrough product in a way that the iMac wasn't, that thing felt like, I don't know if you've, I'm quite old now, but whenever I've held a packet of cigarettes in my hand, even though I'm not a smoker, it kind of feels right. And the iPod had that feeling about it. It just felt good in your hands in the same way that the AirPod case feels good in your hands. And when you open the lid and it clicks, that feels good. Analysts don't get that kind of stuff. And they didn't understand how that sort of loyalty to that business meant that even if Apple only got 10% market share in the mobile market, it was still going to get all the most profitable customers. They just missed that en masse. And I think it was because they just looked at the numbers. They said, well, Android's growing, it's dominating. It's going to have 80 and 90% of the market. Apple's stuffed. And you could buy Apple on 8 or 9 times earnings at that point.
Yeah, this is not something that is like a transient thing. This has been a factor through many years, even more recently with the shift from products to services and subscriptions and these types of things. So many great investors that I know have said publicly, like, it doesn't make sense. And then within 2 or 3 years, they've got 700 million subscribers. And you think this, I would have thought that once you're in the ecosystem, you understand, you listen to some of Jobs' early speeches and heard that message through time. But I guess this comes back to that idea of, like, sometimes there's the narrative the company's saying and the narrative that other people, maybe they just miss it completely.
Maybe. And I don't know whether Apple ever publicly announced its own narrative. I think if a company has a narrative it wants to spin, it wants to tell you, that is a kind of a bit of a warning sign. I think generally we prefer companies just to get on doing what they're doing, building the business, and the narrative, the numbers will start speaking to themselves, and that will become the narrative. I don't think Apple ever went out and said, we're at the intersection of the liberal arts and technology, and that's where our products are, and we really think about the user. But there was that sort of feeling that the most of the brokers, most of the analysts missed that story, but they missed it again when Steve Jobs died and Tim Cook took over, and they went, well, Tim Cook's not Steve Jobs. Steve Jobs was a genius by that point. A weird genius who, like existed on carrots for 3 months at a time. But he wasn't Steve. He wasn't Tim Cook. And they missed that too, because by that point, Apple had got to a stage where the biggest issue was supplying enough of the things it was selling. It was a supply chain business as much as it was a product-based business. And he was exactly the right person. And Steve Jobs had inculcated a kind of Hewlett-Packard mentality, an engineering and design-led mentality in that business that would be replicated after he died. And that has been proven to be the case since he died 10 or 12 years ago, whenever it was. And that narrative was missed too. So I think that even in the biggest companies, and you can probably say this about Amazon too, they miss what's really going on in the business, because the numbers, you don't see it in the numbers. You need to go further than that. You need to learn about the people in the business. You need to learn about the supply chain. You need to learn about how the customers feel about it to get those big winners down the track.
I'm going to digress for a moment. How do you think then, so this type of investing, which resonates really strongly with me, John, how do you think about, so like the rise of, it's a very buzzword, but artificial intelligence, taking jobs, investing for us, taking the job of a fund manager. How do you think about that as it relates to the way you invest?
Well, I'm just doing a story at the moment. There's the two parts. One part was published last week on the emerging bubble in AI. I think the biggest bubble we've had since the dot-com boom was probably crypto. I don't feel as though that was a proper bubble. It didn't really expand it fully into every area of society. And I don't think there was ever anything really tangibly real behind it. And a bubble needs something real. And I think AI is real, and it will have massive impacts. But there's always the optimists, and then there's the pessimists. And we've got both of those with AI now. And I think from here on in, we've already had the massive investments by the big Silicon Valley companies. The VCs are already on board. If this bubble continues in the way that I suspect it might, we're going to start seeing CEOs are going to be mentioning AI a hell of a lot more in their earnings calls. We're going to have all of the opportunists come in and start saying, well, I'm launching this company. We'll have mining companies turning into AI companies, just as we did have during the dot-com boom. Now, I suspect that's where it's going to go, and we'll get a full-on mania. And it's not something I want to participate in, but this is a narrative bias again. We've got a world-changing technology. I'm sure it's going to have massive, massive impacts, but the enthusiasm for it will outpace the adoption of this technology, and we're likely to have another kind of bubble that we saw in the dot-com boom. I think that's a possibility. I'm not saying it's likely. It's a possibility. It seems it's heading in that direction. I would rather be in businesses like Google and Amazon and Apple and take part in that kind of thing. But when a bubble bursts, often there are some really good opportunities around, and we saw that in the dot-com era, and we saw that in the GFC too.
So another company that is quite different is Microsoft, which is a business that, probably if you put them in a spreadsheet, you'd probably say they do exactly the same thing. They make very similar things. They are all in the same sector.
Yeah.
But the narratives which surround those two businesses are vastly different.
Totally different. And I think this goes back to where Microsoft started compared to Apple. They were both around at the same kind of time. And Bill Gates' genius was to get the MS-DOS system installed on IBM PCs, and that became the de facto operating system for PCs. He absolutely nailed the distribution, which Apple never did. Apple kind of nailed the operating system, but distribution was the key to dominating the PC market. And once you had widespread adoption of PCs at home and also at work, they kind of stitched that market up. But they completely missed mobile. They completely stuffed it because they were so desperate to jam Windows into everything that the the mobile revolution. So the narrative was really very different between Steve Jobs and Bill Gates. Bill Gates was there. He rode that wave, the PC wave. And when that broke and the mobile wave came along, they completely missed it because they were way too focused on having Windows as the center of everything. And it was only when Nadella came in and broke all of that down and said, look, we have to leave this behind us. We need all of Microsoft products on every operating system, on every device. And it was a different kind of thing. So it was still a distribution-based mentality, but it wasn't with Windows at the center of everything. And Microsoft, like when I bought Apple, I was really thinking, can I bring myself to buy Microsoft? Because I really don't like their products. I really don't like them. I just don't like the interaction you get on Microsoft products. And that was probably my bias. But it was cheap. But that company could have gone under, I think. You know, it was always there in the corporate system. It was failing in devices, still kind of fails in personal devices. But Nadella's made that switch, and it's kind of a brilliant business now.
Oh, and the cloud business is incredible.
Incredible.
Yeah. So the last one, and we'll call for a couple of questions. If you want to ask John a question, please drop them into the chat now. But maybe just the last one, which might be just the narrative around Amazon. Like for many years, people said that Amazon's not profitable. It's the same story that I heard with Xero for a long time in Australia, and still do for that matter. Very similar in the narrative and what people believed about something. But I'm curious how you think about the business that is now the everything store.
Okay. Well, when I try and think about a business, I like to kind of map it out, how it makes money, and draw it as a picture, as an image, a graphic, if you like, just to kind of get that visual picture in my mind. And Amazon is quite challenging because it's so complicated and there's so many different businesses in it. And for a long time, its principal business didn't make money, and it didn't look as though it was ever going to make money. But I read one of the few business books that I would recommend is Good to Great by Jim Rogers, where he talks about the flywheel effect. And I think Amazon is just a classic example of that. So that business that they built that probably will still struggle to make good returns. It might make modest returns, which is the products-based business, books originally, but now the everything store. From that, they have built a whole series of other businesses that spin around that. So they create these modules in logistics, in cloud storage, in advertising that are all built on this business that doesn't make much, but are much, much better quality businesses around it. So you have these flywheels around one giant flywheel. And I think that's the way to think about Amazon. It's a flywheel with flywheels surrounding it. And that's the best way to conceptualize it, I think.
I remember when I heard Jeff Bezos talk on the Rubenstein show not too long ago, he basically said that we just solve our own problems and those turn into products and services.
That's it.
And that's where AWS came from and so many other great things. There was a question from Rajan that's just come through. It says, John, do you think Apple have corrected their model now?
What was wrong with it in the first place?
I think maybe Microsoft. Maybe it was a Microsoft question.
Yeah. Jim Collins, just been corrected by Ryan about Jim Collins is the author of Good to Great. Sorry about that. I don't think. I think Microsoft is a much, much better model now than what it was. They're not wedded to Windows. It's a SaaS-based business. They're in cloud storage. They've got an absolute lock on the corporate sector. The valuation is a different thing, but in terms of business sustainability, I think they've got an excellent model now. And the problem for all the other SaaS businesses, like the companies that are kind of wedging into the corporate sector, is that Microsoft can just come out with a competing product that doesn't need to be anywhere near as good, but if it's bundled with Teams and Word and Office 365, it's there and it's good enough. It doesn't need to be brilliant. And that's the example of a moat. That's the kind of moat that you want as an investment.
It's that old cliche of your app is my feature or your product is my feature.
Right. Right.
You add it on, and it's very hard for
Yeah.
that single independent vendor to compete. And for what it's worth, Rajan, if it was Apple that you were referring to, personally, I think the business models got more impressive through time,
Mm-hmm.
not less. I think that's fair to say. There was another question that I didn't get to, which I'd like to maybe just touch on quickly. So we talk about the narrative around these 3 or 4 companies, if you include Google. How do you seek out the narrative to then try to think about a contrarian view?
I think it's dangerous to look for contrarian views. I think they need to come organically. If you want to take the opposite view, then you can be wrong lots of times, because often the market is right. I think the market is right most of the time. So I wouldn't say that you should look for a contrarian view. But when you see a pile-on effect, like there was with, say, Facebook probably a year ago,
Mm,
and you go, well, you can see that the dominant narrative is that this business is going down the toilet, the reputation stuffed, but the money still keeps coming in. Then there's a contrarian play there, I think. So I would look for dominant narratives, and then I would look to see whether there's a contrary position told by the numbers.
that's good to be backed up by the numbers.
Yeah.
So Jeremy asked the question. I'm not sure how closely you follow the Chinese narrative, but it's
Yeah.
the Chinese businesses, Tencent, Alibaba. There are many businesses, and I'd say that narrative around that, personally speaking, has been very negative
Hmm.
for quite some time, at least from Australia, maybe even
Right.
from the United States. Is that an example of something where, like we were just talking about, like where you might look at the narrative that Chinese companies they're pretty,
Hmm.
they seem pretty
Cheap.
risky and cheap, but does their numbers seem pretty good? How do you think that?
I'll admit I'm a shareholder in Alibaba, and I have been for quite a while. It could easily blow up. No, it couldn't easily blow up. That's wrong. But you could see the board being sacked and a whole range of Communist Party members being installed instead. I think that's the risk. I don't think you can look at Chinese companies and look at their PERs, look at their metrics and go, wow, that's really cheap, without considering that political environment and that geopolitical challenge that China poses. I think there's so much more risk attached to that market than to Western markets.
Mm, mm. Oh, Rajan just clarified that when the model changed for Apple from, I guess, product to distribution and to engineering, was that a mistake, or is that being corrected?
I wouldn't say the model really changed. I think that the emphasis at the head of the business was towards manufacturing and supply chain management and producing at scale at really low prices. Like, they make incredible margins for a technology product. And that was the right emphasis of the business. But in terms of the model itself, you can look at the Vision Pro. So that's exactly the kind of thing that Apple should be bringing out. That is the iPod of this era, I think. I'm not saying it's going to be a success, but they've come in second or third, and they've blown away the competition in terms of the performance and the usability of the product, I suspect, from what I've seen. So I think they're doing the same thing. And I think they're doing the same thing because Steve Jobs inculcated that attitude inside the business of producing good products that users or people really want to use.
And I see Jason's picked up on the dog that he could hear barking behind me. There's a dog protecting the assets. Yes, the assets being the home. If only we had a guard dog to protect the share portfolios in times of uncertainty.
Right.
That would be nice. I did have a few other kind of low-hanging fruit questions for you, John. One was, who are the writers, maybe they're investors as well, maybe they're not, that you look to and you think, wow, I just have a lot of respect for the way this is written, or who writes this and how they think?
Okay. Well, I've probably read every word that Michael Lewis has written.
Right.
Every published word, anyway. He's just a genius. I read Liar's Poker when I was 21, 22. I would urge anybody who's investing in interested in investing to read Michael Lewis. In terms of narrative, he not only does he seem to be just in the right place at the right time, but he can tell a story, man. He really can tell a story. So these are like the thrillers of finance for me. You know, I just can't. His series on the GFC was just astonishing. And anything that you write that gets turned into a book, you know that there's a very strong narrative there. Otherwise, it wouldn't be turned into a film. So Michael Lewis, I just think is fantastic. In Australia on economics, I think Ross Gittings does a really, really good job of communicating complex economic thinking into something that's really accessible, easy to read, fun to read. He's become kind of more polemical over the last few years, I think, but he does an excellent job of it. I really enjoyed reading his stuff. Who else? Matt Levine at Bloomberg. If you're a wonky finance person, he does some really, really interesting things in a very peculiar and odd style, which is uniquely his, but there's a personality to it that I really enjoy, even if the details can be, very much in the weeds. Martin Wolf at the FT, I think, is just a brilliant writer who brings together very, very big concepts. And I think Adam Tooze in economics as well is great too. In terms of financial commentary, quarterly reports and stuff like that, they're kind of boring, I find. Like, we did this for the quarter, and I couldn't really recommend any Australian fund managers for the kind of stuff that you might get from reading Buffett's shareholder letters. Buffett is kind of a brilliant writer, I think, as you sort of alluded to earlier. But they're there. You just have to go looking for them.
I've got one more question, maybe before we'll say good night and thank you, which is, I guess, a lot of this talk about investing and a lot about, what we talk about is good writing and so on and so forth, and books to read. You mentioned earlier before that there are only a few finance or business books that you would recommend. So I'm curious, I'm very curious, if you were, say, to all of us watching tonight or watching it back on replay or even just listening, if you were to recommend books for people to understand investing as you see investing, like the important aspects of investing, what would you pick up? Like, where would someone go? I must admit, there is one book that I do like on this topic, which is Investing the Last Liberal Art by Robert Hagstrom.
That's right. That's great.
That's brilliant.
That's great. I would recommend that too. Not many people get into it or have heard of it. I think there's so much I could say about this, but I think if you're going to read a book, not many people read books nowadays. It's a constant battle for me to get the analysts to read novels, because I think that helps with that sort of liberal arts kind of thinking, the imagination that you need to bring to writing a piece. But Rajan's mentioned the Steve Jobs book by Walter Isaacson. That's just exceptional. The two films that were made based on that book are just nowhere near as good as the book itself. It's a fascinating story into the entrepreneurial mindset. In terms of investing, The Making of an American Capitalist, I really don't like the title of it. It's got that kind of a Woodstock for Capitalists feel about it. But it is good. Like, the story of how Buffett got started and how he approached things is really exceptional. It does I wouldn't call it a thriller, but it is very, very, a very interesting read. Liar's Poker is like a thriller. I definitely recommend that to people. Even if you're not interested in finance, that story is incredible. And to look at the salaries in investment banking now, like Michael Lewis left the investment bank that he worked for in London in 1989 or something, because he just thought that was the top. And the secretary was earning £30,000 a year. And he just thought, this is mad. now they're about 200 times higher. And this is the thing about, I suppose, that kind of bubbles. They can go just much, much longer than you think. So there's a few options there for you. But Jim Collins as well. Good to great. It's a fantastic book.
Absolutely. There's so many good recommendations there. And thank you, Rajan, for dropping that one into the chat. I will be answering some questions that we did miss before that relate to ETFs and those types of things. But John, it's been an absolute pleasure. I mean, I feel like we could talk all night. I think
We
I might
definitely
need
could.
one of those drinks that you've got. That
Yeah,
might help me out.
I'd need to refill it, but maybe another time.
Yeah, but I do really appreciate it. And anyone who is watching or listening tonight, there is a link in your podcast. I'm sorry, in your video player, not the podcast player, but in the video player. You can click that and you can go to the Intelligent Investor website and hopefully catch part 2 of John's story. So you can go and check that out, as well as get investment ideas and research from the Intelligent Investor team. John, thank you for taking some time to join us on a Wednesday night.
Thank you, Owen. It's been fun.
Thanks. So that was John Addis, founder of Intelligent Investor and now editor. As you can see, he's a wealth of knowledge, and he's approaching this thing which we talked about over the past 2 weeks, this value investing idea, from a completely different perspective. And it's interesting, John is the second person to recommend through the channels which I work on. He's the second person to recommend The Making of an American Capitalist. It's a book on the life of Warren Buffett, in one day. So this is the second time I've had that recommendation in just one day. I'll show you what it looks like. And I did see some questions come through that were from on ETFs and those types of things. So I will have time to answer them now. But this is the book right here. I went back and read it for the second time earlier this year. And I've got to say, the second time I read it, it was better than the first time, because the first time I probably wasn't ready for some of the bigger takeaways. But it's a brilliant book, whether you're a beginner or intermediate. Pick it up. It's well worth the read. And it's quite easy to read because it takes you on a story of Warren Buffett in the early days, selling secondhand pinball machines and renting them out and these types of things. So I did see one question come through a bit earlier on, and I thought maybe I'd be a better place to answer this one, which was from Benjamin, who asked, Benjamin, you said, I've been investing in VGS for the past 3 years. This is the ETF, and considering BGBL, that's the new Beta Shares ETF, the global or B Global ETF, or IVV for a lower fee. Which of these would be a better long-term holding? So just to confirm on the screen, you're talking about you currently invest in this ETF, which is one of the biggest ETFs in Australia. I think it's the second or third. And maybe you're thinking of switching to this ETF or the new one from Beta Shares, which is this one. So I'll start with this because this is the newest on the list and it's the one that people don't know. I obviously cannot tell you what to do, so I encourage you to get financial advice and speak to them about your objectives. Also, download the PDS, which is available on the Beta Shares website. So this ETF is a direct competitor to VGS. And I don't know this, but I believe this to be the case, that this was launched, this ETF, to go head-to-head with the Vanguard ETF, which is VGS. And as you can see, the management fee of 0.08 is meaningfully lower than the Vanguard equivalent. So if investors starting today think, well, why not just go with this one if it's very much the same? I think there's a few things at play here. One of the considerations you and all investors may want to take into account is that typically over time, Vanguard does lower its fees. And I think Beta Shares will too over time. But typically Vanguard does lower its fees over time. So you may make the case that if I'm going to hold this thing for 10 or 20 years, which is an extremely long period of time, maybe I just stick with what I've got and keep things simple, knowing that fees will probably come down. I think, to John's point, I think fees are extremely important. I think they're extremely important. But my view over the years has softened on this, in that fees probably they definitely shouldn't be the only thing that investors think about. There's plenty of reasons why that's true. But it comes to a point where, the fees don't matter nearly as much as the actual decisions that you make with your behavior, and what you do with your money and how you invest, how much you invest, how often you invest, and these types of things. So I guess the answer is it could be both. It could be one of them. I personally don't like the idea of paying tax. So if I was sitting on a gain from my investment and I was thinking of switching, I wouldn't do that if I was going to incur a lot of capital gains tax or brokerage costs or those types of things. Speaking of brokerage costs, I should mention, I did ask Alex behind the keyboard before, there is a promo going on. I saw it on the Selfwealth website, $2 US for a trade. So if you're trading international shares or US shares, $2 per trade. until the end of August, and you can go down to $25 parcel sizes. So it's making it more accessible, which is fantastic. And Benny, you just did say that VAS dropped its fees to 0.07. They did drop the fees significantly recently. VAS being the big ETF, I'll bring that up on the screen. VAS being Australia's biggest ETF is the Australian Shares ETF from Vanguard. Dropped its fees recently. And that's, I would say, partly in response to some of the competitors dropping their fees. Benny, you will know this. We had Balaji on the show not too long ago when we did our ETF mini series. And I'll try and get this. Go pal, Selfwealth. We did have him on the show not too long ago, and he spoke about, we kind of teased him. We said, come on, mate, surely you're going to drop your fees sooner or later on VAS if everyone else is dropping their fees. And he did hint at the way they think about it is they have a certain policy on how they think about lowering fees. And I can see Alex here in the chat has said that $2 brokerage. She says $25 US is the min parcel size for the US market, limited time only. Great, wonderful. There was another question that you have watched the mini series 3 times, Owen. Well, fantastic. I'm glad to hear that you're getting so much from it, mate, because that's why we do it. So there was a question earlier on. This one, Jason, was hilarious that started off the chat. I saw this before we hit record. Know of any ASX-listed submarine rescue companies? And I think that's in relation to the submarine that may have gone missing near the Titanic. I think that may be what you're referring to there. But there was another question put down about Soul Pattinson, Washington H. Soul Pattinson, which is the company that we've talked about a lot lately. So Washington H. Soul Pattinson, I can't find the question in the feed right now, but Washington H. Soul Pattinson, there was a question like, can it keep compounding? And I thought I'd maybe just weigh in on that really quickly. So I'll just bring up the annual report for Washington H. Soul Pattinson. You may remember, or you may not if you have only tuned in recently to Selfwealth Live, that Washington H. Soul Pattinson is a company that it's kind of like an ETF, but it's different. It's actually a company. It's not what we call a trust. In a trust, you have like an ETF is a trust, for example. In that, you have a legal structure where you actually own the things that are inside the ETF, whereas this, the company owns the investments inside it. And so what's inside of it? Well, all of this stuff. So there's more detail breakdown, actually, all of this stuff right here. So inside Washington H. Soul Pattinson, if you place a trade for the shares and you click buy, what you're actually getting is a company that owns other companies. And so you can see here the different types of investments that are inside of it. And the question around continuing to compound is actually this one. What I wanted to bring up is this right here, private equity, and this thing here called structured yield, and this thing here called emerging. So these 3 smaller parts of its business are the things that I'm really interested in. And you can see they're investing in some of them. So traditionally, Washington H. Soul Pattinson has been known to go and buy other companies either outright or to buy big stakes in them. And the reason that they does that is it buys them and then earns the dividends and then can support them to grow and then maybe sells them many years later. But what Soul Pats is doing more recently is it's actually moving in a different direction. It's actually investing more of its money into buying or investing in private assets. So whether that's private companies or offering loans to private companies in a bid, I believe, to basically do more with less. You see, what we know as investors in the stock market, let's say you log into your Selfwealth account. In your Selfwealth account, you will see ETFs and you will see shares, and these are just what we call public companies. So you'll see ETFs and shares, and the ETFs just bundle up the shares or the bonds and puts them together in a basket, which you buy. Outside of the ASX, and the stock market as a whole, there are, in some instances, 5 times the companies, maybe 10 times, maybe 20 times, maybe 50 or 100 times the companies, depending on the market. Meaning there are more companies that are not on the stock market than are on the stock market. And the reason I bring this up is that we're seeing more companies stay off the stock market for a very long period of time, and sometimes never become public companies and go onto the stock market. What Soulpats is doing is Soulpats is able to bridge both of those worlds and invest in private companies or invest in companies that are on the stock exchange. And that's what makes it different from an ETF. An ETF cannot do the private stuff. It's just not possible. And I don't think it'll ever be possible for an ETF to do that. At least if it is, I'd probably run 1,000 miles. And so if you want that type of investing, you need to go and you need to look at companies like Soul Pattinson or other types of investments that might be able to facilitate that. And in my opinion, that is a key competitive advantage and a reason to consider these types of investments alongside ETFs. You don't need to do that. There's no need to do it, but it's something that I think about a lot. And so that's why I wanted to air that and kind of touch on that. I think the opportunity for them is quite significant outside of what they've been known to do historically. Everyone talks about the VAS ETF, says Robert. What would be a comparable option? Well, there are about 4 or 5. Okay, so let me just quickly show you. Here we go. So the most comparable options, we've got the VAS ETF. We've got A200, which is from BetaShares. It's the lowest cost Australian shares ETF. We've got STW from Spider. We have IOZ from iShares. So this is another massive ETF. We have MVW, which is not equivalent. I want to be clear about this. It's not equivalent, but it's a similar ETF. It invests in the top 100 companies, but they're equally weighted, meaning that every one of them gets the same weighting inside the ETF, whereas VAS is what we call market cap weighted, meaning that the top 300, it goes by size. The biggest companies get the most size inside the ETF. And you can see that here. So at the moment, it's got 82 companies inside it. So it's roughly, I say top 100, it's roughly the top 100. But here you can see it's got 80 at the moment. So it's a bit more concentrated or fewer names in there. So Caroline, you said, so is that similar to what a LIC does, as in Soulpats? So going back to the Soulpats comment, yes, it is. It's very similar. But there's one very subtle difference between these two. The reason we don't call Soul Pattinson a LIC, Caroline, is because Soul Pattinson wasn't set up to be an investment company. It was set up to run pharmacies over 100 years ago. And then it evolved to investing its float or investing the money that it had left over in other businesses. So it ended up investing in other companies. And then that thing grew so big that it was bigger than the chemists. So it's not a listed investment company, because a listed investment company has the sole purpose of being an investment company from the outset. So like Wilson Asset Management, or WAM, which is run by Jeff Wilson, or Naos Asset Management, which is run by Sebastian Evans. These types of listed investment companies, or MFF Capital by Chris McKay, these types of entities only have the purpose of buying parts of other businesses, whereas Soulpats can run other businesses. It can actually run businesses itself, if that makes sense. So I can see a great quote, a great comment from Jeremy. Way too late, he says. That's fine. Owen, more and more I'm realizing the core is good for staying ahead of inflation, but to become exceptionally wealthy, picking the micro/small caps that grow into big caps is essential, you say. I think you went on to say something. Are there any resources you recommend for how to get better at picking getting a lot better at picking small caps? Yes. So maybe I should say a few things about small cap stocks. I've got a couple of minutes for more questions. So small cap stocks, Jeremy and everyone, are much more risky. So that's obvious. The thing that happens with small cap stocks is they tend to, as an entire group, outperform their larger peers. So in the 1970s, there was this research done. I think it was Farmer and French. Those are the two researchers who did the study initially. And they found in all the data, this was before we had computers to crunch each and every single thing, what they found is that depending on the size of a company, size tends to be a factor that explains returns. What I mean by that is, let's unpack the jargon. What that means is smaller companies tend to do better on average than big companies. Now, you might be thinking, okay, great, let's go and invest in smaller companies then. Hold up a minute. Smaller companies also tend to be meaningfully riskier. And it's pretty obvious why. Some of the smaller companies have greater levels of variability. So, what I mean by that is some companies can become a zero and some companies can go on and return 1,000%. You don't really tend to get that with your Telstras or your BHPs or your Apples or your Microsofts. In the small cap land, I often say that if you made 10 investments, even if you were doing decent research, maybe 3 of them work out, maybe 2 of them. But hopefully those 1 or 2 outweigh the 5 or 6 that you get wrong. There's another really important distinction that I want to make with small cap investing. It's that you cannot afford to be as lazy. And this is fair. Like you cannot afford to just take your eyes off what the companies are doing, because those companies, let's say a small cap company has 30 employees and one CEO who owns a lot of the company and has been steering it for a few years in the right direction. Let's say that one person leaves and you don't see that, and that person's the visionary. Probably the shares will fall 40 or 50% if they're so integral to the business. And that's wouldn't be unheard of if that founder abruptly left. Now, if you think about it, in a business of 30 employees, if the founder leaves and it's a really good founder, done a really good job, and they just left unexpectedly, obviously investors are going to be spooked, but that one person has a lot of impact over the fortunes of that business. But now let's imagine Tim Cook, the CEO of Apple, who John mentioned before, leaves. I think Apple's got over 100,000 employees. I could be wrong, but let's say they do. If he left, there's a few other people that could take that job. And so the dependency on that one person, that one variable, which is a human being in this instance, is not as significant. So I just want to add this as context for you, Jerry. I know this wasn't the question, but the range of outcomes are significant. But if you know what you're doing, I am convinced that really experienced investors should spend almost all of their time in dealing with small and medium-sized companies and not nearly as much time looking at the big companies. Sure, they would look at them, but just not nearly as much. And if you want to learn about it, I would say go and find 5 really good small cap fund managers. They publish their letters every month or every quarter. Don't get sold into their marketing or their alluring ideas, but go and find 5 small cap fund managers. Use Twitter, go online and search a database, and just read their monthly letters. All 5 of them, read them for a year, and then figure out, take notes, and learn. Nathan Bell, who's been on the show, who's a colleague of John Addis, who was just on the show, so he works for Intelligent Investor. He's maybe one of these investors that you can follow. So whether or not you're an Intelligent Investor, I'm not sure, but that would be one. I enjoy the letters from Lake House Capital. I enjoy the letters from DMX Asset Management. I enjoy the letters from Curtis Larson of Norse Capital. I enjoy the letters from so many of these Australian investors, but those are some examples. Okay. 2 more questions. How about that? Kadar said, how much percentage do you think is good for such exposure to Sol Pattinson for a high risk portfolio? Kadar, unfortunately, I cannot answer that because it goes too close to personalized advice. But what I could say is that for me personally, everyone is different. For me, if I think about my core portfolio and my satellites going around the outside, I would be happy to have Sol Pattinson in the core. Whereas some people would be not very, like some people watching this would say, I'll just put ETFs in there and I'll stick with that. I'd be happy to put Sol Pattinson in there, but I wouldn't just invest everything at once, because the difference between Sol Pattinson and an ETF is a share price of Sol Pattinson can do this a lot. So that's what I'd say. Yeah. So you've said, Jeremy, I enjoyed the letters from RSK2. Not sure if you've come across them. I don't know, but I don't know what you're saying, but I'll give you a thumbs up. James, final question. You've said, switching tack, is precious metals worth exposure? Some interest in palladium, which is relatively unknown. James, interest in precious metals has been around for a very long time. So whether it's palladium, whether it's even things that aren't precious anymore, like things, well, they are, but not in the way we think about them. Things like copper, lithium, which is not a metal per se. These types of things, the commodities of tomorrow are becoming more interesting. And there are many businesses on the ASX that can provide exposure to the mining of these precious metals. Like there's Linus Rare Earths, which is rare earths, which goes into batteries. But I guess for my part in my portfolio, the only thing that I've considered of any substance, like as in a position that would be worth talking about, is gold. It's the only thing that I've ever considered worth investing. That's not to say that palladium and nickel and all those other things that people are interested in more recently. So I would say those are okay. I wouldn't have them in the core of my portfolio because I think, as maybe say like a Warren Buffett might say, is I want as many things in my portfolio that produce growth and income. There aren't many things that you can invest in this world that provide both the growth and income, but shares are one of those. Commodities are not. So, Penny says, FYI, lithium is technically a metal, the lightest of all metals. I did not know that, Penny. Thank you. Chef Circle, you've said, Owen, have you written a finance book? There's the last question for tonight. I have not, although I am thinking of writing one in 2024. So there's a bit of insight. I haven't started it yet, but I am considering writing one. I just don't know how many people read. Send me a message. Let me know what you think I should write the book on, because some people tell me I should write it on value investing. Others tell me I should write it on ETFs. Others tell me I should write it on business. Others tell me I should write it on psychology. So there's a lot to go. I don't want to create a library of books, but if I could put thoughts down and if I knew people would read it, I would. But here's a special thing. Chef Circle. So I'll let you in and everyone listening to this. Around 150,000 people tune into the Rask podcast every month. A best-selling book in the business category in Australia, I think, needs to sell about 5,000 copies. How many people of those 5,000 will actually finish the book versus how many people listen to the podcast religiously every week or every month? I can tell you how many times people listen. They listen for many times a month. And so I've often thought about our impact as a business and as an individual and what we do for the world. And that's the thing that's always held me back from writing a book. So if you think I'm wrong, like if you think, like I'm very open-minded about this and I've debated this at length, but personally, I find it hard to put a month aside to writing a book that maybe 10,000 people read or 20,000 people, if I'm lucky, read, when we can publish podcasts and do videos like this one that reach so many thousands of people so quickly and probably have a more readily available impact on their lives. So that's what I would say. Anyway, I will call it a night and we will see you next week. We do have a very, very interesting guest coming up next week. We've got Nick Cummings on the show. He'll be talking to us about two global stocks. Now, these two global stocks that he'll be talking to us about next week are a flooring company, get this, and an investment company. So we'll be talking about these two businesses and why he finds them so appealing. I really am looking forward to it because we're going to get a practical boots on the ground analyst who studied in the US. Actually, you're going to get him to look and put a bow on all of the series so far. So that'll be next week. And the final quote for this evening, actually, John gave this to me right before the live show. And he said, I write entirely to find out what I'm thinking. And this is a fantastic quote. And I think it sums up why writing is so important. If you are an investor in individual stocks, in ETFs, or if you're just a person who goes through life, have a journal, have something to write down. It doesn't have to be much. Just write it down. And then remember, you can go back to it in time. I do have the journal beside my bed. for that very reason. So thank you. Thank you, everyone who tuned in tonight. I think Rob is back next week or the week after. We might even surprise him. I did look at the Selfwealth YouTube channel before. I got to admit, I'd looked at it before, and we had 9,993. That's the Selfwealth YouTube channel, ladies and gentlemen. 9,993. That would mean there needs to be 70 more, and there's 10,000, which is incredible. So wonderful, considering where we started not too long ago. So thank you, everyone. Robbie's back next week, says Alex. Bye for now. Thank you, everyone who came tonight. We will see you